Welcome to Financial Habits. In this video we are going to talk about ARK Investment, the best funds. So before starting this video, like this video, and subscribe to Financial Habits for future updates. ARK Investment Management, or ARK Invest, founded by Cathie Wood, is one of Wall Street's hottest asset managers today. Assets under administration increased more than tenfold last year from $3.1 billion to $34.5 billion, thanks to a mix of excellent performance and fund inflows. The ARK Innovation ETF, ticker ARKK, is the firm's most popular exchange-traded fund, with a year-over-year return of 150%. Wood's other ARK ETFs have comparable track records. For example, the ARK Genomic Revolution ETF, ARKG, is up 160% in the last year as of this writing. ARK had acquired an AUM of more than $50 billion as of early February, thanks to more than $11 billion in inflows into Wood's funds following a fantastic 2020. Cathie Wood and ARK Invest are, in a nutshell, the envy of all fund managers. For the time being. However, there is one risk that investors who are rushing into ARK ETFs may not be considering seriously enough. Investors are chasing gains and flocking to ETFs that are hot. When funds go through a dry spell, they tend to do the exact opposite. For what it's worth, this is an inconvenient pattern for individual investors who wind up purchasing high and selling low. According to a 2007 research published in the Journal of Banking and Finance by Jeffrey Friesen and Travis Sapp on fund performance, timing decisions caused equity fund investors to underperform the funds by 1.56% yearly between 1991 and 2004. This adds up over time, especially when compounded annually. From 2000 until the end of 2009, a Morningstar survey showed a nearly identical tidbit. The average equity and bond fund returned 3.18% yearly, but the average investor earned only 1.68%, a difference of 150 basis points a year. What exactly does that imply? It merely confirms that investors are chasing returns, buying at high levels and selling when things go south. It also suggests that if ARK has a bad run, we can expect redemption. And that's when things may start to go nasty. ETFs, unlike mutual funds, are not required to retain cash on hand to protect against investors selling or redeeming fund shares. Instead, when investors redeem their ETF shares authorized, participants must sell shares of the underlying securities through a unit creation and redemption process. ARK has an issue because it has a big number of holdings in which it owns a big percentage of outstanding shares. Obviously, these are smaller businesses with lower daily trade volumes. The underlying stocks will have to be sold if investors start selling ARK ETFs. As of February 13, ARK Invest controlled more than 10% of the outstanding shares in a total of 25 firms. One concern that may emerge here is if this implies that ARK's problem is one of liquidity or fund flows. Those two, in my opinion, are inextricably intertwined. I'd say it's a possible illiquidity issue that will become apparent if there are a large number of outflows. The Bear Cave newsletter's creator, Edwin Dorsey, adds, if there are inflows, it doesn't matter how liquid you are, because you can't stop buying items. It's similar to how if a bank is undercapitalized, but everyone keeps putting money, the bank will never fail, according to Dorsey. If there are a lot of abrupt outflows, it's a liquidity concern that will come to the forefront of everyone's consciousness, he says. Knowing about ARK's concentration difficulties makes abandoning positions difficult, but it also makes its funds vulnerable to hedge funds selling or shorting some of these more illiquid names, according to Dorsey. If people start saying, "Oh, ARK's performing poorly. Retail investors are starting to redeem, let's turn them upside down," you're going to have all these funds shorting these names, pushing them lower, anticipating ARK to do that next week, he says. It's a feedback loop with the capability of compounding on itself. ARK will not obtain a good price on the open market if it needs to sell big numbers of minor companies, overloading the market with shares. Of course, this lowers the performance of ARK ETFs, increasing the likelihood of more redemptions if investors' well-known inclination to sell in downturns remains true. The remainder ARK is very aware of how concentrated its portfolio in some names has grown. The fund family secretly modified its prospectus on Friday to tweak its own ETF portfolio criteria. ARK ETFs can now invest more than 30% of their assets in a single security and own more than 20% of a single firm. To put those now abandoned restrictions in perspective, many diversified mutual funds will invest no more than 5% of their assets in any single security and no more than 20% or 25% of their assets in any single sector. ARK's move to abandon these earlier concentration guidelines may prevent the firm from inadvertently breaking its own restrictions if present trends continue, but it only adds to the problem that Dorsey and others have been lamenting. In any case, a period of underperformance is almost certain to follow, even if it isn't due only to liquidity concerns. The concentrated nature of the holdings, says Robert Johnson, a finance professor at Creighton University in Omaha, Nebraska, is the largest risk to Cathie Wood and ARKK. And by that, I don't mean a particular industry, but rather the type of companies the fund invests in, disruptive innovation. These enterprises attract money when liquidity and optimism are strong. That's something we've seen throughout the last year. In essence, she has a thematically concentrated portfolio, Wood, according to Johnson. Although ARK's particular challenge of holding significant percentages of less heavily traded companies is likely the most overlooked risk element to its funds, Johnson's view is a different matter. Another concern may arise as a result of Cathie Wood's extremely successful tenure, which helped the firm's assets grow from roughly $3 billion to more than $50 billion in just over a year. It's the declining returns on bigger sums of money. If you're very hot, you'll have a lot of money to deal with, and it'll be a lot more difficult to handle. Since the biggest chances tend to be in smaller stocks, that are the most mispriced, and you can't really invest in them, unless you have a lot of money because they don't move the needle, according to Dorsey. What do you think about this video? Do let us know down in the comment section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.